Hello students, this is Varsha Taware from Department of Business Administration. Today we are conducting the lectures on source of the finance. So what is meant by the finance? Finance is a manipulation and the summarization of our money. So there are two types of sources in the finance, and that term is most important for our finance. So sources of finance can be viewed through three main lenses: the period for which funds are needed, of the ownership of those funds, and the manner in which they are generated. Let's explore each category of the in details. On the basis of the periods, there are two types of the source of finance. One is the long term sources of the finance, and second one is the short term sources of the finance. In the long term sources of the finance, these are used for major capital investments such as purchasing fixed assets, expanding operations, or funding long term projects. The repayment period is typically more than the 1 year. For example, in that the long term sources of the finance, equity share, preference shares, debenture, and term loans are included. What is meant by equity share? Equity share is the part of the some amount or the part of the some shares in the capital. So the permanent capital raised from the public or the private investor. Preference shares is the fund obtained with the preferential dividend rights, often with specific redemption terms. Then third one is the debenture, long term debt instrument issued by the companies with fixed rate of the interest. There is a no floating rate for the interest, there is a fixed rate of the interest. After that, the term loans provided by bank or the financial institution, usually for the specific period or for a specific duration beyond the year. This is the concept of the long term sources. After that, second one is the short term sources. These sources addresses immediate or temporary financial needs, generally for period of up to 1 year. They are often used for working capital requirement like day-to-day operations. For example, trade credit, short-term bank loans, overdraft, and public deposit. Trade credit, short-term credit extended or by the supplier. Short-term bank loan or overdraft, funds available quickly to the liquidity needs. Public deposit, money borrowed from the public on the short-term basis. This is the public deposit. Then main second point is the on the basis of the ownership. On the basis of the ownership, there are two types of the sources are there or the funds are there. This perspective focuses on the who ultimately bears the risk and the control of our fund. First one is the own fund, second one is the borrowed fund. What is meant by own fund? These funds are contributed by the owners or the generated internally in the or by the business. They include shares capital, retained earnings, bonus shares, and the reserve. After that, borrowed fund means the external fund. These funds come from the outside of our company and must be repaid usually with the interest. So they include the debenture, bond, bank loans, and the advances. After that, on the basis of the sources of generation of the finance, they are classified into the external sources or the internal sources. External sources of the finance. In that, internal or external. In the internal sources, retain profits, shares of existing assets, cut down stock level. External sources, long term, medium term, short term. In the long term, shares, debenture, long term bank loans, and the grants. In the medium term sources, leasing, hire purchase, medium term loans are there. In the short term, bank overdraft, bank loan, creditors, and the debt factoring are there. Now, in the external sources, what is meant by equity share? Equity share represent ownership in the company and are issued to raise the permanent capital from the investor. After that, second one is the types of the share. In that, two types of the shares are there. One is the equity share, second one is the preference share. In the preference share, cumulative and non-cumulative preference shares are there. Participative and non-participative preference shares are there. Convertible and non-convertible preference shares are there. So what is meant by preference share? Preference share are the types of the equity that provide the fixed dividend and preferential rights over a common equity shareholders. Then nature and the features of that share. Fixed dividends are given here, non-voting shares, limiting of the shareholder influence and may be redeemable or the irredeemable. After that, types of the preference share: cumulative, non-cumulative, redeemable, irredeemable, convertible and non-convertible preference share. What is the advantages and disadvantages for that? It is a earning capacity increases. Fixed dividend makes the preference shares attractive to the investor, does not dilute control of existing equity shareholder, and third one is the increases financial stability without increasing its burdens. What is the disadvantages for that? Fixed dividend payment method is there. So in that, financial burden for the low profit year. When the low profit in the year is gaining, that time financial burden is on the owner. So second one is the preference dividend payment are not tax deductible. Dividend given to the shareholder, but that not are the tax deductible. Then the less flexibility is here. It is a common equity financing. After that, debenture. Debenture are the long-term debt instrument issued by the companies to raise the fund at a fixed interest rate. In the debenture, interest rates are the fixed, not the floating. So nature and the features of the debenture. Debenture holders are the creditors only, they are not owners. Interest is paid regularly irrespective of the profit, and it can be secured or unsecured. Then the types of debenture: first one is the secured and unsecured debenture, second one is the convertible and non-convertible debenture, and third one is the redeemable or the perpetual debenture. What is the advantages and disadvantages for that? Interest payment are tax deductible. If interest payment is done here, tax concession or tax exemptions are given here. Lower cost compared to the equity financing, and it does not dilute the ownership and the control. What is the disadvantages for that? Regular interest payment create a financial burden. Every month have the interest rate or every years have the interest rate, so it creates the financial burden. Failure to meet the interest obligation can lead to legal action. If interest obligations are there, legal actions are taken. After that, require collateral for the secured debenture. Then public deposits. What is meant by public deposit? Companies can raise short-term finance by accepting deposit from the public at a fixed interest rate. It is the public deposit. Nature and features of the public deposit. Generally, it is unsecured, relying on the company reputations. Typically used for working capital or short-term needs. Interest rate is lower than the bank loans but higher than the saving accounts. Advantages: simple procedure with fewer legal formalities, no dilution of ownership as no shares are issued, cheaper compared to the bank borrowing. That are the all advantages for the public deposits. Then disadvantages for that: public confidence is required, only reputed companies can raise the funds. Then risk: premature withdrawal by the depositors, limited availability for long-term funding are there. After that, fifth one is the borrowing from bank. What is meant by borrowing from bank? Bank provide the loans to the customer or any individuals for a short term or a long term from the banks to finance their operations. So type of bank borrowing: one is the short term bank borrowing and second one is the long term bank borrowing. Short term bank borrowing have the use for the daily operations or the working capitals. In that, your cash credit, bill discounting and bank overdraft examples are given. After that, long term borrowing used for the large capital expenditure and the expansion of your projects. Advantages for that: quick access of fund when the business is needed, that is one beneficial advantages of the business. Then the lower interest rate is there, and after that, no dilution for the ownership. Disadvantages are: bank impose strict conditions and require collateral, high repayment burden with fixed monthly installment, interest rate can fluctuate, increasing financial uncertainty. Now the second type of the sources of finance is the internal sources of the finance. Internal sources of the finance refers to the fund generated within the business without external borrowing or issuing shares. These sources help businesses sustain operations, invest in growth and maintain financial stability. So the key internal sources of the finance, in that retained earnings are there, sales of assets are there, depreciation provisions are there. In the retained earning, profits are reinvested in that, profit accumulated over time and reinvested into the businesses. Cost effective as a no interest or repayment is required here, suitable for expansion, research and the development activities of the finance. Second one is the sales of asset. Sale of unused or outdated assets like machinery, land or the vehicles helps free up capital for urgent basis of the business needs, and then sales of asset can provide quick liquidity, but it might reduce future operational capacity. Quick liquidity means within some short period we have to generate cash from that asset. Then last one is the depreciation provision. Funds set aside for the asset replacement due to wear and tear. This is the what is meant by depreciation here. Wear and tear of our assets is called as the depreciation, and that are the provisions for the assets. Funds set aside for the asset replacement due to wear and tear. Whatever wear and tear is there, that funds are provided by the depreciation provision. Then use when business needs to replace fixed asset like the machinery. Depreciation are used when the machinery is the fixed assets. So depreciation is there. Then ensure smooth operation without affecting working capital, means that funds are not collected from the working capital. Fourth one is the reduction in the working capital. Managing inventory, account receivable, payable efficiently, we have to reduce the working capital. Freezing up tie-up of funds to use for the other business needs. It is a risky if mismanaged, as it may impact daily operations. Owner capital, fund from business owner. Money, all that money are invested by only the owner, your shareholders and the partners. No repayment obligation or no interest rate is here. Often used in the startup and small businesses, means SMEs. Sixth one is the delay payment to the creditor. Postponing the supplier payment to retain the cash longer helps improve to short-term liquidity, and then excessive delay may harm supplier for the relationship. So internal sources of the finance, it have the some advantages or the some disadvantages. Advantages is that no interest is there, no repayment is there. Enhances all the financial independence and control, and it improve the business credit worthiness. There are 2 or 3 disadvantages of the internal sources of the finance. Limited availability of fund. Here is the limitedness of the fund is here. Short amounts are here. Slower growth potential compared to the external funding. As compared to the external funding, here fund is the limited, slow. So the growth of the internal sources are the slower. It may impact daily operation if mismanaged. Some cash or some financial decisions are taken wrong. So it is a disadvantages for daily operation are mismanaged. Thank you.